All right. Look, thanks very much for having us, everyone. So what we're going to go through today is the global market outlook for 2024. And joining us is Sean Hollins. So thanks for coming in, Sean.
Great to be here.
So Sean's the head portfolio manager for Willis Towers Watson here in Australia. Obviously helps us out with our portfolios and been doing a great job. So we're keen to hear from Sean around the global market outlook for 2024, which is the Willis Towers Watson's view. Take it away, mate.
Perfect. All right, thank you very much. So I'm going to take you through the 2024 outlook, but let's just take a bit of a recap of the previous year. So 2023, at a glance, it was really a story of economic resilience. Certainly if you rewind back to 12 months ago, we were pretty bearish on what the next 12 months might hold. Interest rates had been increasing, expected to increase further, potential impacts on economic growth. None of that really eventuated. So really the outcomes for markets over the year were exceptionally strong for risky assets. So in 2023, the MSCI World, so that the global equity index returned 24%. Within that, the US returned about 25%. More risky debt issued by US companies earned you about 13.5%, Aussie equities 12.1%. It was a really, really strong year for equities, somewhat surprisingly. And I suppose what led to that was the resilience of economies around the world. Towards the end of the year, inflation showed signs of retreating. That meant that central banks could potentially signal that interest rate cycle is over, and equities rallied on the back of that.
They're very strong numbers, aren't they? So if you have a look, as you just said, the 23 numbers at 24 for global equities is outstanding for our client portfolios, and given we've got allocations to global and then also allocations to Australian equities too, right? So Aussies have probably done half the return, the ASX 300 that is, but still 12%, still really strong.
Yeah.
So, and of course, we're going to talk about 2024 and what happens, but it's important, I think, at times to just reflect upon the fact that 23 was a good year, and won't happen every year.
Yeah.
But it was a good year, so yeah.
Yeah, I mean, we typically expect equities to return around 8 to 9% per annum over the long term. So a return of 24% is exceptional.
Yeah, that's right. So not every year, Sean.
Exactly.
No.
So let's take a look at 2024, and we might do a bit of a tour of the world and then summarise.
Yeah, great.
Sort of the story as a whole.
Yep.
So the US being the largest developed market economy in the world, it makes sense to start here. In 2023, the US consumer really drove the economy in the US. High savings rates from COVID. A lot of people had hoarded cash. They continued to spend during 2023. It meant that the labour market was also quite tight, and that did normalise a little bit towards the end of the year. But more generally, real GDP growth was about 2.5% over the year. That's pretty good considering what had happened to cash rates over the past 18 months. I might just turn to what we're thinking could occur looking ahead. So the way we think about forecasting economic scenarios is that they are scenarios. It's not sort of a point estimate, if you like. We never have 100% conviction that one thing
of course
may occur. So when you're thinking about how to construct a portfolio going forward, we typically like to have a few different scenarios in mind. So the main scenario, the base case scenario, actually is a smooth rebalancing. So in the chart here, that's the left column. A smooth rebalancing essentially assumes that the central bank in the US does an exceptional job of reducing inflation back to more normal levels, but without creating a recession, essentially, without cratering economic growth. Now, that's been the case to date. We are seeing inflation trend down towards more normal levels. Our base case actually is that is likely to continue.
Yeah.
So in that environment, inflation is around 2.5% at the for the 12 months end of 2024. The cash rate in the US trends down actually to 4.6%. Currently, that's within the range of around 5.25 to 5.5%.
Yeah, so still some reduction.
Yep, so a reduction
2024.
in the cash rate, and then real GDP growth of 1.4%, which
Yep.
is not exceptionally strong, but it's strong enough to keep the economy chugging along.
It's interesting, isn't it? Because the drivers over the last couple of years of equity markets and global economies has been what is the rate of inflation? So what's it going to be, and how quickly will it pull back? And I think it's actually pretty close to 2.4 now anyway. It's 3 something, isn't it? So,
Yeah, that's right.
So which is great, and because we've been worried, everyone's been worried, and markets have been worried that actually what we are going to see is some volatility and more volatility, and we have seen that, but still to be in a position where we're in at the moment where things have been okay, you'd have to almost call that, not yet, but almost call it a success, right?
Yeah. We are still worried that the smooth rebalancing is our base case. There are 2 other scenarios that we are concerned about. So macro volatility is where inflation doesn't fall as quickly as what central banks would like. In that scenario, there's uncertainty about future inflation, uncertainty about future interest rates. You'll see some volatility not just in the economy but also in investment markets.
Yeah.
And the other scenario, which we think is plausible, is a minor recession. Now, I'll speak to what that could look like shortly, but you rewind 12 months ago, we actually had a major recession as being one of the things that we were worried about.
Yep.
We think we've escaped a major recession with sort of the work that's been done to date by central banks and the sort of the lack of impact, if you like, on economic output. But a more minor recession would see inflation fall. Given economic growth falls, inflation would fall. I think the main potential cause of a minor recession from here is if the Federal Reserve keeps them too high for too long.
Yes.
Right. And in that scenario, we potentially could see growth fall. In response to that, the Federal Reserve would then need to cut rates pretty aggressively. But by that point, it's sort of too late.
Yeah, sure.
If you like. So and then that scenario, you'd see growth of, just above zero, essentially. So we are worried about those 2 other scenarios, but the smooth rebalancing is actually our base case at the moment in the US. A little bit about the US labour market, which I think is really interesting. So post-COVID, when there was a strong recovery in activity, we saw that there were essentially too many jobs available and too few applicants. And what that meant was that essentially the labour market was imbalanced. It led to pretty significant wage growth in the US, upwards of sort of around 7% per annum, which historically is extremely high. Wage inflation led to more general inflation. So generally that's not a great thing. That is starting to normalise.
Yes.
So we are seeing fewer jobs out there, more applicants, sort of that gap closing. That's good for, I guess, resetting to a more normal level of wage growth, a more normal level of inflation going ahead.
Okay. Yeah.
So in terms of what this means for financial markets, particularly in the US, market participants are expecting the Federal Reserve to cut their cash rate 3 times over the next year. We have a somewhat similar view to the Fed and other market participants. If that was to occur, then bonds are a pretty attractive asset class in the US. As bond yields fall, the prices rise. So that would be a good thing for bonds. And just a little anecdote as well. Obviously, we mentioned previously about the huge strength of global equity markets and the US equity market in particular. That's led to quite an unusual scenario where a small number of stocks in the global index within the US index are taking up a large proportion of that index. So there's a nice little chart here showing that the sum of Apple, Microsoft and Amazon in the global equity index as at the end of 2023 is quite similar to the weight of all the companies in Japan, all the companies in the UK, all the companies in France.
Yeah, that's incredible, isn't it? I mean, and you can see that's from 2013 to 2023, right? So what's that? Almost a quadrupling of the size of some of those stocks, and a reduction in the size of the Japanese stock market, the UK stock market as well. So, yeah, that's fascinating. It really has been it's a great story for those companies, but it's also been a great ride.
Yeah, absolutely. Okay, so touch briefly on Europe. So, from a developed markets perspective globally, Europe is a bit of an outlier. So Europe's been particularly weak over the past 12 months, particularly in Germany. Consumers have not been spending. There's been less demand for the goods that they produce. So economic activity has been exceptionally weak, and GDP growth is around zero in a lot of European countries and the euro area in aggregate. And that, it's I guess what that's led to, or what's caused that is inflation is very, very low, right? So what that likely means is that the European Central Bank will likely cut rates. Inflation is around that sort of 2%.
Just to try and get the GDP growth numbers up back into positive
Yeah,
territory.
exactly.
And maybe they left it a little late. Or,
Exactly.
Yeah.
Turning to Australia, a pretty similar story to the US. The economy has remained much more resilient than certainly I expected and many others expected. Some of that's been driven by immigration since COVID, since the reopening post-COVID. Services have picked up, so a lot of people coming to Australia to study. That's one of the key drivers of the Australian economy. That's led to a bit more resilience in economic growth in Australia than we otherwise would have thought. So GDP growth around 2.1% for 2023. Similar to the US, we do think policy rates have likely peaked.
Yeah, right.
Now, inflation in Australia hasn't come down quite as much as in the US. We do expect that to trend downwards. But in terms of the pace and the timing of maybe a first interest rate cut, maybe it's a little bit delayed compared to the US, given where inflation is. So, we're still reasonably confident in the prospects for Australia. Potentially you might see rate cuts a little bit later and a little bit less aggressively than in the US.
Well, we lagged on the way up too, right? We lagged the
Yes, that's correct.
So it kind of just makes sense that it's taking longer.
Closely related to Australia, China. So I see a lot of news snippets out there on what's happening in China at the moment. Some pretty significant problems in their property market. Some large property developers going into bankruptcy. A lot of talk about GDP growth being pretty weak in China. That's a little bit misplaced. So over 2023, China grew over 5%. Now that's lower than their historical numbers, but you compare that to a lot of the large economies around the world, that's still pretty strong. We expected that once the economy reopened after COVID, and that the reopening there was a lot more lagged than what it was elsewhere in the world, that we'd see the consumer come out in force. That didn't really happen. Consumers actually do have quite a bit of spare cash in the economy, but they haven't been spending. They're just not confident about the future prospects of their own economy. We do see some difficulties coming up in the Chinese economy. However, the government there has a lot of levers to pull, potentially more levers than other economies around the world. And so if we do sort of see a sort of extended lull in economic activity, we would expect to see some pretty significant stimulus from the Chinese government. So maybe just turning to the asset class views. So with the increase in bond yields that we've seen over recent times, we do think government bonds, boring as they might be, are a pretty good place to be at the moment. We expect some pretty decent returns over a 3 to 5 year period, but also with yields being a lot higher now than what they were 18 months ago, in addition to providing a reasonably consistent return through time, we think that in a more balanced portfolio which has quite a bit of equity exposure in it, bonds can provide that cushion if we were to see a minor or major
Yes.
recession.
Yes.
So there's a lot of scope for bond yields to fall, sort of in response to any sort of recessionary activity that we might see.
Yeah, which is traditionally how they've always acted in that type of environment, right?
Yeah.
Bonds become king.
Yeah.
People
But
flight to safety.
you look back 18 months ago and bond yields were so skinny that we weren't actually advising clients to invest in bonds for diversification, right? Because you wouldn't expect them to provide that cushion at such low levels of yields.
Yeah, and they've had a hard period over probably that last 18 months too. But
Yep.
with interest rates now, with bond yields rising and getting to that, was about 5% for 10 years, I think.
Yep.
And now starting to drop off, you're picking up some of that capital upside.
Yeah, yeah, exactly right.
So you're getting rewarded for investing in that asset class now.
Yeah, so bonds are exciting again and a closely related asset class of credit. So this is sort of debt issued by, in this case, investment grade companies. We think that should tick along quite nicely over a 3 to 5 year period. In the absence of significant defaults, which we're not envisaging, obviously could happen. We're not expecting that to occur. You are expecting a pickup of a couple of percent over and above a government bond return
Yep.
at the moment.
Okay.
Equities, so as I said, exceptionally strong returns over the past 12 months. We actually think that over a 5 year period that equities are still pretty neutrally valued. We wouldn't say that they're exceptionally expensive at the moment, but we are concerned over the next 12 months. So the earnings expectations built in to market pricing might be a little bit optimistic. So while I've said previously that not expecting a recession or a major recession, even in that smooth rebalancing scenario, growth will tick down, and in that sort of weakening growth environment, potentially the earnings that are embedded into market pricing may not eventuate. And so, over the next 12 months, we're less optimistic about equities compared to sort of the average over the next 5 years. Foreign currency, so the US dollar has appreciated relative to a lot of other major currencies over the past few years. Has been led by cash rates in the US being quite a bit higher compared to other markets around the world. That's starting to reduce that difference. So we see potentially less capital flowing to the US, meaning that something like the Aussie dollar potentially appreciating over the next few years relative to the US dollar. Important to know if you're going on holiday to the US.
It is. It would be.
So in summary, we do see the economic environment continuing to almost trend sideways, if you like, leading to conditions which are sustainable and such that the economy can keep its head above water. Certainly not expecting a major recession. A minor recession is possible, but what we're expecting actually is central banks around the world to be able to successfully navigate sort of the twin aims of reducing inflation to a somewhat normal level, whilst not causing growth to plummet to negative levels. So over the next 12 months, we hope that the activity from the past 12 months continues.
Yes.
And we see sort of soft but still positive economic growth and inflation trending down to normal levels.
Well, let's hope that is the case. As we all know, this is predicting the future, which is fraught with difficulty. But no, that's fantastic.
Just finally, what does that mean for constructing a portfolio? So, as I said before, I think bonds are back. We think a pretty simple equity and bond portfolio can do reasonably well. We certainly weren't advocating clients to dive into bonds a couple of years ago. We are now, where bonds are at we think actually equities and bonds can be sort of lowly correlated to each other and together generate a pretty steady and decent return over the next 5 years.
Yeah, yeah. I mean, I think that's, and as you know, helping us build the portfolios, and as our clients know, having a portfolio with different pieces of diversification in it really helps. And that's certainly our approach. So it's great to hear that typical bond to equity type portfolio is positioned well for the next 1, 3, 5, 10 years, because it's how we diversify our portfolios.
Yep,
yeah,
absolutely.
no big bets. Excellent. Well, Sean, thanks so much. We really appreciate you coming in. And the way you explain things is excellent and in simple terms, which is how we need it. So thanks very much. Appreciate that. Thanks very much, everyone. If you got to the end, well done. And we'll see you next month. See you guys.
Thank you.